Welcome back to another episode of What's on Your Mind. David Perlin and Jason McDonald join me today. Gents, it's going to be great to have your thoughts on the markets once again on the series. Now, since our last episode aired on the 25th of October, quite a lot's happened in the markets. The Fed has continued easing rates, and that's kind of shown up in new all-time highs in the S&P 500 and also a normalizing of the US yield curve. And what I mean by that is that essentially the yield curve, the US yield curve, is upward sloping across all maturities now. So David, I'm interested in hearing what your thoughts are on that, and also, what that's led to in your own analysis.
Good morning, gents. Great to see you guys again.
Hey, David.
I think the biggest takeaway is that we've had enough stability and help from the Fed and confidence to finally break through fairly convincingly on this very stubborn 3,000 S&P level, which was kind of a bump along resistance for some time. Now, mind you, we're about 3%-ish through that level, which is not a gigantic breakthrough, but it's certainly new highs. And obviously there's this tension currently between kind of FOMO, fear of missing out, which is all the rage in the business press of late, versus wait, what has really changed? Do we have enough global momentum to drive earnings even higher, to justify multiple expansion, to get significantly higher in index levels? Also, a lot of people are starting to talk about VIX at 12, which is obviously an extremely low historical level. And rates have actually ticked up a bit, even though the Fed has cut their Fed funds rate. The short end has been creeping up a bit. And there's this balance between the market being excited about a normalized yield curve, i.e. is no longer inverted. But conversely, we're starting to see a little bit of a tilt higher in the short end as economic activity and risk on has kind of shaped that. It doesn't feel at all like a year ago when the markets were really under duress. I think the biggest difference between then and now, obviously, is the Fed back then was raising rates, and this year they are cutting rates. And that's put us in this position to have this kind of Santa Claus rally, as it's traditionally labeled. So I think that's been the backdrop. I think the last thing to add is, earnings have been expected to show some sort of slowdown. And I think, in fact, that's happened, but it's been robust enough to promote risk on. And largely, analysts have been cautious, and most results look like a meet or beat in general, which has kind of added a little bit more fuel to this rally.
So given that rates backdrop, David, has that kind of led you to any sector or stock ideas?
Yeah, I think one of the things that really helped this market, and observationally, we've seen some fairly robust rotations where, the concentrated leadership in tech has been shared with other sectors in this rally, which I would argue is a much healthier way to make new highs. But in addition to that, one of the groups that really broke out, certainly after a decent earnings period, were the banks. And one I want to feature alongside is called Capital One, COF. It is, if anybody watches TV, a very aggressive credit card marketing company. But they are a bank, and they benefit from this normalized yield curve. They too had very good earnings in the last period, just last month. In general, most of the banks have invested in technologies that have improved their margins and their ability to execute their business, and that's kind of underappreciated. If anybody wants to do some research, Mark Mayo at Wells Fargo has written extensively about this. And also, interestingly, they're kind of changing the branch model. In America, when you go to the bank, pick a bank, you go to a big glass window, kind of plexiglass secure window, and talk to a teller through a microphone, or you're waiting this bad kind of semi waiting room for a bank person to help you open an account, et cetera. It's just kind of not a great experience. So Capital One's introducing this cafe formula where, literally there's a espresso bar and you hang out and everything's done mobile. And I think they're really going to appeal to millennials who don't want to have like a bricks and mortar old style bank experience. And I think that's a way for them to grow their deposit base. So I think that's an interesting kind of riff on rates have changed. I want to be along a bank. I want to be along a bank that has something else going for it. And that's how I got to this name. Book value, all these banks are below 1, which is kind of historically low. Price to book value, I should say. And, with better operations, better technology, better experience, better margins, I think you'll see an expansion of price to book over time, certainly over this year, if the rate structure continues to look like it is.
Let's switch over to you, Jason. You were actually discussing something quite interesting about IPOs and private equity offline. Do you want to expand a little bit on that?
Actually, I was just thinking the other day about the IPO situation. Obviously, fairly current given the whole sort of WeWork debacle in the last few weeks. And so generally, I was looking at the sort of whole IPO private equity situation. And that's actually led me to a stock idea, which I'll talk about a bit later on. And also, be interesting to get David's view a bit later on as well, because I know that he's had a ton of experience on the IPO market. But essentially what I was kind of zoning in on was that if you look at the number of companies listed in the last 20 years in the US, is actually halved over that period. And what we're actually seeing is that companies are essentially staying private for longer, and they're getting privately funded for longer. Just to throw a few statistics out there, back in 2013, I think 25% of the equity raised from new shares was sourced from private markets. Last year, that number's up to almost a half at 48%. And the trend is still, going upwards in that regard. I think the global private equity market has got about $4.2 trillion under management, assets under management. So that's obviously a significant asset class now. And, if we go back to the whole WeWork situation, a common criticism of the availability of such large quantities of private money means that, some companies have essentially been kind of accused of hiding their losses by simply raising more money. And that's clearly something that we could level at the WeWork situation. And then this has knock-on effects as well, because these private companies are staying longer in private hands, although their businesses may well be larger by the time they actually IPO, by delaying the IPO event, they're effectively kind of delaying the time at which public markets will properly scrutinize them. And so what you often see is it becomes a case of kind of pursuing growth at any expense, the emphasis being on expense here, and not profitability. And I think we've actually seen a whole host of failed IPOs crashing and burning this year, with the so-called sort of unicorn situations. I think, we've seen some structural things come into play as well, where if we look back at what's been going on the regulatory side, certainly for the last 20 years or so, it's now easier for startups and private backers to raise capital. For example, some of the anti-fraud rules governing share sales have been relaxed. And I think what this has led to is this situation that we've had this year with basically a growing list of failed IPOs. So we can think of the obvious examples, well, the IPOs that didn't happen, but also the ones that have happened and have really been very disappointing. So the likes of Lyft, Smile, Direct Club. So this has, got me thinking about the whole sort of IPO market, and it's led me to a short idea, not surprisingly, but just wondered actually what your thoughts are on the issues here, David?
Yeah, I think it's spot on that private capital has become so prevalent and so large that companies just have changed their model of financing their growth. And the public market has loudly penalized these companies this year and basically said, shame on you. You could have come public 2 years ago and we would have shared in the pop. Instead, you're just making it an exit for the private investor and we're not buying it. We don't see we don't see profits. We don't see you running your business for profit. And we're not going to finance it like SoftBank does. So I think it's been a resounding, loud chorus of, voting with price. And I think it's been eye-opening. I think it'll be really interesting what happens next with Airbnb, which is kind of the remaining major unicorn out there. The distinction is they could do a direct listing, which a few of the companies have been able to do. Direct listing essentially is a separate process from an IPO. You don't really raise money. You just take the existing company, list shares, and don't raise money in conjunction with it. So well-capitalized private companies have been doing that, Slack being probably the latest big example. And that would argue that the world just votes on what your price should be instead of an investment banker kind of running a process for you. So I think that could be a distinction for Airbnb, but I'm really interested in, does that sentiment continue and does the results of these companies, the reception continue? But, just looking back at all the IPOs that I was able to touch and manage back in the days in Goldman Equities, companies came public much earlier in their life cycle with much fewer private investors that were waiting to get paid back, and I think that's the biggest distinction in this market.
Well, let's move on and explore that idea, Jason. Given that backdrop.
Yeah. Okay. So the short idea that I've come up with is Peloton, ticker PTON. Market cap's just under $7 billion. So what are they? Those of you familiar with cycling probably understand the word Peloton. So the company calls itself a happiness selling company, which is a fantastic description. I think that it's essentially a gym equipment company selling memberships, but call me old-fashioned. So they sell these exercise bikes that come with a fancy 22-inch Android screen. And then you pay a subscription on a monthly basis to basically do spinning, so stationary cycling at home. So we've got a few parallels here with the WeWork failed IPO, or the IPO that didn't happen, because one of the criticisms there was, well, this is basically a property company trying to pretend that it's a tech company. Why would they do that? Well, clearly there's a difference in how investors value property companies versus technology companies. So the answer is obvious there. With Peloton, similar situation. They're trying to argue that they're a tech company. They're in the business of selling happiness. Who isn't, quite frankly? But they're basically selling very expensive exercise bikes that cost $2,245 to purchase, and you've got to pay $40 a month to subscribe to sit the classes at home. So this thing, as I say, it's got a market cap of $7 billion, just under. It doesn't pay a dividend. It is very unlikely to make a profit in the next 5 years. That's according to the analysts. So this is 5 years. Think about that. A lot can happen in 5 years. It will burn cash during that period. The IPO was a bit of a stinker. The IPO price was $29. The highest it's traded at is about 28. It's currently around $24. So I'm looking at basically building into it. I don't think I've come up with an amazingly original idea here. So I do think that I'm probably not the only person thinking about being short of this thing. So I think it's one where you build into it and you basically sell into rallies. It's only been trading for a few weeks. So we've got to see a bit of, history developing here. But in terms of the numbers, the metrics, they had their first report as a public company on November the 5th for the quarter ending September. The analysts were expecting on a consensual basis a loss of 36 cents per share. They came in with a loss of $1.29, which is obviously a massive miss. They did have a small beat on the sales side, but clearly at some stage, investors want to see profits and not increasing losses. As I say, it's not going to make money for at least 5 years. It's going to burn cash. The analysts don't really have anywhere to go on this stock. The 95% of them have it as a buy or a strong buy. The rest have it on a hold, which I think is actually one person. So they've got nowhere to go with this apart from downgrading it. I mentioned the addressable market. These bikes, they're not cheap. $2,200 for a bike and a $40 per month subscription means that these are not available to everybody. So you've got to think about, in my mind, you have to think about how big is the addressable market. And I think effectively to get to the numbers that the street is building in, and they're on average only targeting a $30 valuation on this thing. I think essentially the company has to sell one of their bikes to every household in the US that earns over $100,000. That's possible, but I'd say unlikely. And of course, if that revenue growth that we see, because they don't earn any profits, slows, then I think you're going to see the valuation hit quite badly. I think there's also an issue over the intellectual property side of it. They're actually involved in a legal case on that side. It's not really a big thing at the moment, but let's see how that develops. So then really with these companies that don't have any earnings, the only way that we can really value them is obviously on a multiple of revenue. So this is where the sort of definition of the sector really comes into play, because is this company, is it just a gym membership company, or is it a hardware company? Is it a wearable, a subscription media, luxury apparel, etc., etc.? Now there's a nice two-way case here that we've seen in lots of other stocks like Tesla, Netflix, for example. So the bulls on this stock would say it's got a best-in-class direct-to-consumer story, sort of a la Netflix, Spotify, Lululemon. People like me on the bearish side of it would say, well, hang on a minute, have a look at something like Fitbit. I hear you say Google have just bid for them. Yes, they have. $7.35 cash. And the stock IPO'd at $20 back in 2015. Got up as high as $45. It's now being bought by Google for $7.35. So I guess you could say every dog has their day eventually. And we've got other examples littered around as well. GoPro is another one that was up at $85 in 2015. It's now $4.50. UAA, which is Under Armour, another form of growth darling of the market, $50 in 2015, now below 20, down at languishing around $17. So how you classify this stock and where you value it? There's a massive range of outcomes here. For at the extreme end, we've got something like Roku, which is a streaming company on 14 times sales. GoPro on less than half times sales. Peloton's on more than 4 times sales. So there's obviously a massive range here. My bet is that they're challenged in terms of their addressable market. It's actually not a technology company. It's just a gym membership company. And I really don't think it should be valued in the same way as some of those other stocks. So as I say, my strategy here is to build into a short position. So that obviously feeds back to our IPO discussion that we've had.
So we've talked about your stock that you were looking at, David, on the long side. What about anything on the short side?
Actually, I have an intriguing short that I've been watching and trading occasionally, and that is Yelp, YELP. which is an internet kind of review site like TripAdvisor, and it's basically any kind of site that has commentary about experience, restaurants, hotels, etc. And they make money on the advertising around it. The issue I have with it is, as a person who's actually looked at it occasionally as a user, is that the reviews are usually rubbish, as in not useful. And there's been a huge problem with all these review-oriented sites about real objectivity, meaning there are plenty of people getting paid to review a specific restaurant or a hotel, and that's not disclosed. So, if I don't know who to rely on. I'll read a bunch of reviews and I don't know who's getting paid and who's not. Obviously, if you're getting paid, you're going to say what the company wants you to say, or the entity wants you to say. So, it's been a growth tech-oriented stock. It's consumer-facing, obviously, but it's had a lot of volatility around earnings. And the last earnings period was actually upside volatility, where they actually did not have a bad outcome, and the stock kind of gapped. And I do believe, part of that is short interest in the stock, which is, about 12.5% of float, and above 6 in the short ratio, which is a bit high. The other thing that's really high is PEG, which is approaching 5. It's got a 50 PE for this year, 35 for next year. And I just think that this is a kind of stock we can at least range trade. And I'd love to trade this from 37 down to 30, and try to capture the next quarter, which I would suspect will be disappointing after a relief rally quarter. So this is the kind of thing we can do through options. So, define your risk and make sure we have the duration to get through the quarter. But this is a stock that I don't believe in its model, and I don't believe in its validity. So I'm kind of fundamentally opposed to this working as an entity. And the last thing I'd say is that they recently had a rumor that they were going to combine with Groupon, GRPN, which quite frankly is barely a living and breathing company. So I think that's a good sign of desperation, if you will. And it's that anecdotal thing that makes me want to put it on here.
Yeah, I think the sort of facts about review sites is so sort of interesting in terms of, they're buying reviews. So many of them are untrustworthy. We had an interesting case, I think, in London where some guy managed to get his restaurant to the top of TripAdvisor, and he was just serving soup out of his backyard. and people were coming in from newspapers to eat there and everything. It's crazy.
Case in point, right?
Yeah. Okay, let's go back to you, Jason, then, to finish up. You had a long you were thinking about mentioning as well.
This is going to sound pretty boring, actually. So the idea is the company's called Boston Beer Company, ticker's SAM, market cap about $4.3 billion. The company has no debt. It's not massively liquid. It's sufficiently liquid, but you have to just trade it carefully with limits. But it's a stock that I bought into last week, just below $350, and I mean a lot of our US viewers will know the company. So it's one of the largest craft brewers in the US. They produce things like Sam Adams Boston Lager, other beers, and I think their famous cider brand is Angry Orchard. But that's clearly not where the growth is coming from, and I'll talk about that. So just to give you the sort of the profile of the company, we're talking about a company, as I say, $4.3 billion market cap, no debt. PE for this year for F1 is 38 times, which obviously for a beer company is fairly rich. 31 times for F2, which of course we are now rapidly approaching. We've got earnings growth of 23% in F1, 24% F2. So we're looking at a PEG of 1.7 for this year and 1.3 for next year. So, just to put that into context, the average industry PE ratio for this year, and we're talking about companies like, Molson Coors, Bud, as in Anheuser, Busch, InBev, Heineken, Diageo, etc. They're trading around 22 times. So this company is trading at a fairly decent premium. And so, the reason for that is because of something called the hard seltzer market. So what really sort of caused me to have a look at this stock was it's had a great year, but it's actually now 20% off its high. So it got up to just shy of $450. As I say, it actually got down below 350. It was in the low 340s at one point. It kind of fell to just above its 200-day moving average, which for the TA motivated people out there is a fairly significant support or resistance, depending on from which direction it's coming. It's bounced off that. It's still sitting in a fairly bullish channel. I'm essentially looking for it to run into December and early next year, and looking to take sort of 15 to 25% out of it. I did expect it to consolidate around the 350s, but it's actually had a run up in the last couple of days on the back of there was a deal in the sector, somebody buying out some minorities, and it's just kind of focused the market on smaller companies in the sector. But in terms of the fundamentals for this company, they had their Q3 report at the end of October on the 29th. They beat on both sales to the tune of 4% and earnings by 28%. They raised their guidance as well by 4%. So they had the kind of trifecta. But as I say, the stocks, it already fell ahead of the numbers, and it continued to fall a little bit. It had a bit of a rally, and then it fell back again. That's the fifth straight quarter that they beat on earnings. It's the fourth out of 5 quarters that they've beaten on sales. There's a very simple growth story here. And as I said, it's around this thing called hard seltzer, which is a fast-growing carbonated alcoholic drink market. So I haven't tasted their brand, but their big brand is called Truly. There's only one other brand that's in the market, which is something called White Claw, which is produced by a privately owned company. So this is where their growth is coming from. To give you an idea of that growth, they Truly grew its volumes by 3 digits in percentage terms in Q3. They have this other thing called Twisted Tea, which is growing its volumes in the last quarter by double digits. And then obviously, not surprisingly, the company is really focusing on that part of their business. It's now the biggest element of their sales. They've just announced a multi-year deal with the NHL, the National Hockey League. So Truly is the official league drink, and they've also announced some other things there with respect to Sam Adams and Dogfish Head, which is another one of their craft lagers. So they're really focusing on this hard seltzer thing. It's where the growth is coming from. You've had a decent pullback. I think it looks interesting from a chart perspective. There are some catalysts which are, a bit further down the road. We're talking early next year of they're rolling out further formats for their Truly hard lemonade drink and some of the other flavors. If you want to play devil's advocate here, which we should always do, clearly the negative side of the ledger here is that they're still exposed to, let's face it, a pretty moribund beer business. Beer is a highly competitive environment, and it's not got the same attractive demographics as it once did. They are doing something about that, which is why they're expanding a lot in this seltzer business. So as I said, I picked some up last week, and I'm looking for hopefully a quick sort of 20% gain on that.
I don't find beer or hard seltzer at all boring.
I've never tasted hard seltzer, but I like it.
It's a refreshing beverage, and the fact that you can start something like this that is basically a new category within beverages and ramp it that quickly and really have a duopoly is amazing. It's just a good trick for anybody out there. If you can identify a company that's adding something that's taking off like this, it's another catalyst for a stock idea. So bravo. Yeah, absolutely.
All right, interesting stuff this week. We covered a lot of ground, guys, some good longs and shorts there. I think it was particularly interesting to hear about the sort of IPO and PE backdrop as well that's been happening for the last sort of few years. So thanks for both coming on the show again and sharing your ideas. Now, for you guys watching and listening, there's a couple of events that I just want to make sure you know about as far as ITPM's concerned. You might be interested, if you're an alumni student of ours, about an upcoming webinar that Anton and Ross are doing on the 16th of November. The title is Bond Market Indicators. So if you're interested in learning more about bond markets, then do try and sign up for that webinar. That's on Saturday, so the day after release of this episode. Also, we've got another webinar coming up that's open to the public. That's another Lossaholics Anonymous webinar. That's hosted by Jason here and Anton on the 23rd of November. And like I said, that's open to the public. So if you guys are interested in coming along to one of our webinars, then make sure you head to the website, our website, and sign up. So that's a wrap for today. I hope you guys enjoyed the show, and make sure you join us next time for another episode of What's on Your Mind.